welcome to the trade. The US Federal Reserve has delivered a highly anticipated interest rate cut.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
Now, however, Jerome Powell says another rate cut in December is not a foregone conclusion. That's especially given the lack of data because of the US government shutdown.
And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risk.
Now, Jerome Powell says the board expects the impact of tariffs on prices to be short-lived, but he warns that inflation could be persistent.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
Now, further adjustments to policy will see the Fed end its quantitative tightening on December the 1st. Meanwhile, the Bank of Canada has cut its policy rate by 25 basis points to 2.25%. That's in response to the effects of US tariffs persisting, signalling that settings are at the right place as long as the economy grows in line with its forecasts. The US 2-year Treasury yield rose to 3.6% following the Fed's decision, while the 10-year yield rose to 4.07%. Now, markets have priced in a 65% chance the Fed funds rate will be cut by 25 basis points at the next meeting in December, an extra 3 more cuts expected in this easing cycle. The US dollar index is up 0.6% on the day. The Aussie dollar has eased to 65.8 US cents. So let's get across the charts now. Nick Twidale from ATFX joins us. Now, firstly, what's happening with the Australian dollar, especially after that rise in inflation?
Well, the Aussie's remarkably resilient considering what we got from the Fed last night. So, yes, we are off a bit from higher than the 66 cent level, but we've come down and we're probably one of the stronger currencies on the crosses than some of the other majors. So, Aussie, it's dropped back off, but after the inflation reading, we're really pulling back on RBA rate cut expectations, and a lot of people are saying that's kind of what we were getting strong hints from the RBA about anyway. So I think for now, the Aussie is probably one of the few majors that's probably going to be bid on dips relative to the dollar in the next few sessions, whereas I think for some of the other majors, we're probably going to see them more a sell on rallies type scenario.
Seems pretty range bound.
We've said it a few times, haven't we? It's been pretty boring, the Aussie, to be honest, over the last few months. If you look back at like those lows in July, they're just under 64 cents. We've topped out at just around 67, but the majority of the time, kind of 64.5, 66 has done us. So it's a nice trade to trade on the range, and I think even with what we've got from that inflation data last week, I think it keeps it range bound against the dollar.
So what's happening with the euro now?
So Euro's taking a little bit of a dip because we've seen some dollar buying across the board. It's now back at the bottom of its, and it's been a relatively tight range as well, but we're back on support line that comes back all the way back to, this is the daily chart, of course, that trend line goes all the way back from February. So it's going to be interesting in the next few sessions to see what happens with the dollar. If we start to see FX markets really run with this much more, I suppose, less dovish really Fed, we could see a break to the downside, and that could open the way for a move down to that 200-day moving average at 113.
Now, a lot happening in Japan with the new Prime Minister, and that has hit the yen.
Well, that is something that's going to be fascinating today. Obviously, we've got the Bank of Japan coming up. We've also got Trump talking to us from Korea. He's Korea, isn't it?
Yeah, South Korea, APEC.
So I think we've got Trump first around 1 o'clock our time. I think we've got the Bank of Japan normally around 2 p.m. So expecting massive volatility, which we always get from the yen anyway. But what we could get today, and for FX traders in particular, is a really good interest rate differential trade coming in for the longer term. With that less dovish Fed or even hawkish Fed, we're seeing the Bank of Japan pull back. And as you can see here, we're at close to multi-highs. If it breaks up and attacks that trend line resistance, dollar yen could really break through. So we're not expecting anything from the Bank of Japan today, but their forward guidance could be very interesting given the change of government and given what we're expecting from the new government, which is going to be a bit more stimulus, pulls back from their hawkish stance that they've had for the last few months. So that could be the big mover. Dollar yen, if it breaks through that topside line, we could see it attack those highs that we saw earlier in the year.
And how's the British pound doing?
That's the mover, actually. That's moved. That has seen a break on the technicals. That will come up in a second. So it's down nicely, right? It broke through that trend line support. It's kind of ahead of the euro in many aspects, and that's typical of cable. You'll get a 60-point move out of Europe at 120 out cable. So now I think that's the one that could open the way. We're probably targeting 130 as a key psych level, and then down that support trend line comes in around about 126.50.
Okay. Nick Twidale from
That's all right.
ATFX Securities. Thank you so much for joining us.
No problem. Thank you for having me.